I told you that. We say like if the market is bullish like this,
Are you still there? Because I can't hear you anymore.
I'm just hearing you very well. I say like
Okay.
if the market is bullish, I told you the result of this structure is due to liquidation processes, right? Liquidation process that is being done into the market. So the
Yeah.
market creates a structure due to the liquidation processes. I told you in the market we have two types of orders. We have limit orders. You have limit orders and then we have stop orders, right? That's around into the market. Limit
Yeah.
orders, hopefully you understand the limit orders, and stop orders, of course, are the orders that you get. We can call them instant execution. You just get into it and then you put the stop loss above,
Yeah.
right? Those are the stop orders. So what happens is this: whenever the market activate the sell order, it can go down. Whenever it activate the buy orders, it goes up. So this is due to liquidation of what? Is due to liquidation of orders that may lead to this price action that you see on the chart. Can you understand that?
Yeah.
Yes. So if anyone asks that question, why do we see these structures are being made? We saw that structure due to the liquidation process that is being done, the liquidation of buy and sell orders, and or buy and sell of limit or I can say buy stop and sell stop orders that are running that are within the market, right? And then I
Yeah.
told you, for example, in here, if we, okay, so if in here we face the sell orders and at this area we face the buy orders, that's why the market goes up. So if for us, we understand this area contain two types of liquidity processes, right? We have buy liquidity process and then we sell liquidity processes. So means now this area we're containing two types of transactions that you are running to this area. So we can call this area as the liquidity area. Can you understand this? This is the liquidity area. The liquidity area, whenever I say the liquidity is equal to money, right? So the area that
Yeah.
was containing the liquidation processes, we can call it the liquidity area. Easy like that. Can you understand that?
Yeah.
Yes. And then I say this, and then I say something like this. And then I say something like this. If, okay, so if the market is bullish, now we want to see this bullish breaks, right? We want to see this bullish breaks to confirm like this market is bullish. And then I say the bullish market has to go up and has to return within these areas here to consume the liquidity. And then you have do what? Go to the upside, right?
So idea. Yeah.
Upside. You understand that? So by having that thing into the mind, then I say this, in order for that liquidation process to be done, I say that if you have, I say that if in order to put things clear, in order to put things into to be aligned, right? I say like we should have proper methods that we may use in order to understand the liquidation processes, right? So in this case, we had two things. We had constant time frames and we have situational time frames. Can you understand that? We have constant and situational time frames. Okay, constant is the time frame that will give you the overall direction to understand where the market is likely to go. In the situation, you're gonna see the situation going into that liquidity area in order for you to get the environment that will make you to take the decisions either to buy or sell. Can you understand that?
Yeah.
And then I say that, for example, if someone tells you in Tanzania there is rainfall, okay, can you believe that? No. Okay, now the one who told you like Tanzania there is rainfall, we can call that a constant news. But whenever you come to Tanzania and then you see like there was a cloud and the rain was raining, now you came and then see the situations and then you proved that yes, Tanzania there is rainfall because I got there and then I looked, the situation was right, right? So then that's how it is. Okay, that's how it is. So if something is acting as constant, it means you use that idea as the directional bias. But situational, you're going to check the liquidation process that is being done in order to give you the overview or to give you the idea about where the market is likely to go. Can you understand that?
Yeah.
Do I go speed? Or today is at least.
It's a what?
Am I going to speed?
No, no, you're a bit better today compared to the other time. Other times you used to be very, very fast, but you're a bit better today.
Okay. And then from that, I say this. From that, I say this. Constant time frame. In here, we have two time frame that we act as constant. We have monthly, and then we have weekly. Okay, so we have these two types of coordination that we may use. We have monthly coordination and we have weekly coordination. Can you understand this? So I say that if monthly is acting as constant, can you understand when I say monthly is acting as constant? When I say monthly acting as a constant time frame, means you go into the monthly and then you get the liquidity area from the what? From the monthly. So the
Yeah.
time frame that will give you the liquidity area is the constant time frame, right? And I
Okay.
said, if the monthly is okay, if the monthly is constant time frame, then the daily will be situational. Okay, so the liquidation process that is being done from the monthly has to be seen on the daily. Then I say, if daily is constant time frame, then the 1 hour will be situational. And then if the 1 hour is constant, the 15 minutes will be situational. And when the 15 minutes is constant, 5 minutes will be situational. Then I say this thing. In this case, whenever we come into the weekly, I say that if the weekly is constant, then 4 hour will be situational. And if 4 hour is constant, then 30 minutes will be situational, right? 30 minutes will be situational. And 30 minutes, if 30 minutes is constant, then 5 minutes will be situational, right? So we have to follow this process here. We have to follow this series of time frames in order for us to get the good results. Can you understand that? In order for us to understand the liquidation processes, to understand how the price was consuming those orders and the area that the orders remain, because the area that has the remained orders will be the area that will turn the market, right? So to understand this liquidation process, these time frames has to be followed. So you have to respect this series of time frames,
Yeah,
right?
but the first one for the monthly, I didn't see 4 hours there, right? You're going from monthly to daily and then 1 hour, 15 minutes.
5 minutes. Can you understand that? So I say that, for example, in this case here, I say this. If you have the liquidity area from the monthly like this, now, in order to get from the monthly liquidity area, we have to see the trend that is being formed from the daily is being invalidated, right? Is being invalidated. So we have to invalidate this trend in order to get into the monthly liquidity area. Can you understand that? So we have to see this bullish trend getting validated, and then market started falling back down into the monthly liquidity area. So whenever the market gets into the monthly liquidity area, we want to see this trend invalidate itself, turn into bullish, right? And then it started going to the upside, outside from the liquidity area. So this bigger thing will be the new liquidity area from the monthly. And this will be the liquidation process in here that we see from the daily, the way market was consuming the orders. Can you understand that?
Yeah.
Can you understand this?
Yeah.
Yes. Then I said, so now you understand, in order for the market to get into the bullish liquidity area from the monthly, they has to be bearish, right? They has to be bearish in order to get into the bullish liquidity area from the monthly. The same
Yeah.
thing, yes, the same thing. If the market get into the bullish liquidity area, now we want to see the trend formed from the daily, but invalidate itself, and then give us the environment for us to take the decisions to go to the upside. So what do we want to see here? What do we want to see here? Now, what we want to see is like this. Or if the monthly has to go down, we want to see the shift from the daily, and then new formation has to be formed from the daily. Okay, so this shift formed from the daily and this new formation formed from the daily will give us the indication if the market will return into these areas to go back downside to get into the liquidity area from the monthly. Okay, and from the monthly, the same thing has to happen. Daily has to shift and then it has to form new formation. Okay, so if they form new formation, we're gonna take decision based on this formation to go to the upside to get outside from this trading range. No, not the trading range, outside from this formation, or outside from this liquidity area from the monthly, right?
Yeah.
So when I say shift in new formation, you can understand that this is shift here happened, and new formation is this, and we have two type of formation here, right? We have two type of formation. We have